Felix, that point about the ECB cutting but raising their inflation. To me, that was maybe the most important thing of the week. You can't blanket it to all central banks, but you basically can, because everybody's said that quiet part out loud, which is the inflation target's a joke. It never meant anything anyways. And we're cutting interest rate despite thinking inflation goes up. I mean, that's completely 180 opposite of everything we've heard from central banks for the last 2-3 years. I think that tells you all you need to know.
Hey everyone, this episode is brought to you by Avalanche. Everyone's favorite red coin is a fan of On the Margin, and we are a fan of Avalanche as well. Talked about it on the program before. Avalanche is a very cool solution. Their subnets allow for a very scalable blockchain that's also interoperable at the same time. And it's not just me. The institutions are noticing, and they're building on the evergreen subnets as well. You're going to be hearing all about some of those institutions later in the episode. For now, Avalanche, thanks for making this possible. All right, everyone. Welcome back to another weekly roundup of On the Margin. You got Felix, Quinn, Tyler, gents. Tyler in the suit today. A little jacket. Looking nice.
Yeah.
So departure from the regular wear that we usually get from you on the show.
Well, I wanted to make it really professional so that the suits actually listen to me when I talk about the volatility selling this time. Because I think that just went completely over everyone's head, but we'll see. We'll get there eventually.
You're copying me.
Yeah.
I like the white tee, though.
That's my quant. We're being tested on our slowing economy thesis. We had a hot jobs print today. Non-farm payrolls came in hot, came in way above expectations at 272,000 new jobs versus the forecasted 185K. But we saw the unemployment rate go to 4% from the forecasted 3.9%. Saw average hourly earnings on a month-over-month basis go to 0.4% over the forecasted 0.3%. And overall, what we're seeing is that despite some, a JOLTS report that came out a few days ago that was soft and some pretty consistent soft economic data, this really usurped a lot of the slowing economy thesis that at least I know I have. That's very different from calling from a recession, but it's definitely testing the thesis. And I want to set up Quinn because I know he has a pretty great analysis / maybe you want to call it a rant on this, but I'd love to lead it to you to unpack what's going on underneath the numbers there.
Yeah, I think I tweeted about it a couple times this week, but it's I think both can be true in like all these cases of discrepancies in interpreting the data. So the economy Q3 GDP print was close to between 8 and 9% nominal, I believe, growth. And so like to not expect to slow down from that pace is insane. And so I think no doubt the economy is slowing from the breakneck speed, but we're still above 5% nominal GDP. And maybe in Q2 we get below 5, but we're still probably above 4. The unemployment rate is inflecting, and I think that's a pattern that's difficult to reverse. Like the metrics around the SOM rule and things like that. There's obvious signs that things are weakening from where they were, but I think we're just in a much different era around understanding this new inflationary regime. And if you look back, like the unemployment rate today is below the peak top of the economy going into 2007, 2008. So, I think there's an element of anchoring bias as well. And all of these things go into why inflation will be entrenched, right? Like in the past, a 4% unemployment rate was fantastic. And today it's like, oh my God, we need to cut rates ASAP, despite inflation being well above the Fed's target. So I think both are true. I don't really see a recession in sight. There's definitely a growth slowdown. But as we've seen with the last number of these, they've been met with stimulus and monetary easing, and it'll probably be short-lived. I think just to touch on the unemployment specific, the point I'd make there, and we have some charts on it, but I think it's hard to ignore that immigration is playing a big role in this. U.S. population growth is the highest it's been in like decades, and border crossings also similar numbers. I think we called this out on a previous, but the number of border apprehensions since Biden took office is just about equal to the number of unemployed people in the workforce. And every policymaker, this isn't a political thing. It's every communication from the Fed and Treasury, Powell and every FOMC, the Treasury and all their QRAs and other economic analysis point this out. And they say immigration is a key driver. I think, seems naive to not think this is partially planned to help get inflation down. Increasing the supply of labor puts downward pressure on wage growth, and that's a big driver of inflation. So, it's an interesting time, but I think all the facts are there, and where the differences in interpretation often get mixed with political, views, but it seems pretty straightforward.
Yeah, I think the discussion around, I'll just go back one more slide here, looking at the foreign-born versus native-born employment levels. And I see the narrative forming here and how that aligns with, just outsized immigration happening currently. But this is obviously call this the demand side for jobs. But looking at the supply side of jobs, the fact is that there's enough companies out there that are willing to hire people that are beating expectations and forecasts. To me means that there's still a strong enough economy underlying it. We could have all the immigration in the world, but if there's not enough supply coming from companies to hire people, then this isn't going to show up in the data. So something is showing up the data that is telling me that the economy is still strong. And that's why I want to make it super clear the distinction between a slowdown and a recession. I don't think we're anywhere near a recession. We're just cooling off from absolutely above trend GDP growth, like ridiculous GDP growth. And that's a nuance that's being missed a lot right now.
The other point, the last thing I'll make is it's the next 2 slides from here, Felix, is the median wage growth, looking at high school or less versus bachelor's degree or higher. So if you notice, basically from the bottom of COVID to the peak of inflation, so mid 2020 to mid 2022, high school or less median wages were growing at a much faster clip than bachelor's or higher. And basically that peaked with inflation and has since come down. And that's another, corroborating data point that says, okay, why is it that only the lower income jobs are being more heavily affected by the recent, employment numbers? And that would imply that, it has to do with immigration as well, because, the people coming across the borders are not, bachelor's degree or higher taking jobs. So I think all this data comes together, and the broader point on this is actually inflation is actually good, I think, for most Americans, because it helps reset that capital labor balance that Tyler always talks about. And we're in this regime now since 2022 where policymakers are saying we're getting inflation down, while in the background they're artificially suppressing interest rates and long-term bond yields, and it's boosting asset markets. So we in mid 2022 to today, we flipped from goods and services inflation to asset price inflation. And that's going to have to reverse. And all of this is the underpinnings of populism, and why Trump, why Biden. They're kind of the same. They're both populist, and people are upset because their wages haven't grown in the bulk of the country.
Mike, Tyler, where do you guys stand on all this dispersion in jobs data?
Quinn, you just mentioned something interesting just about who benefits in an inflationary type regime. I think that it's hard to do. Often the trope that you hear is that it's an incredibly regressive tax, but oftentimes actually there's decent data that supports that sometimes the lowest income earners actually tend to do pretty well during inflation. I like this mental model from Lynn Alden of who inflation really hurts is creditors for the most part, because the credit that they've extended in their debt assets end up getting inflated away the most. I would say, though, it's hard to put a one size fits all, because it ends up being pretty uneven based on the regime that's happening. Like, I just listened to this podcast, so it's fresh in my mind, but in like the 70s in Britain, the inflation that they were going through, how you were impacted was largely a factor of which union you were a part of. And these unions, ironically, were driving a lot of the inflations because they were successfully bargaining for 20 or 30% wage hikes for people that were in their union on a year-over-year basis. So that was both part of the inflation, but if you were a part of one of those unions, you were actually protected and you were doing fine or even outpacing inflation. But if you weren't part of those unions, then you were getting screwed. And so I think we're going to have to wait a little while to see. I don't think you can cast it with such a broad brush of just being like, it's good for this group of people or that group of people. On the ground, it's going to differ. And I think we just have to wait and see how it actually shakes out, to see who's coming out on top of this.
What's interesting is I'm looking at the break-even rates, which is, forward break-evens 2 years out. So this is what the market is implying inflation to be 2 years from now. So 2.14%. It's come down massively, which is a huge boon to assets. If you have, this is why bond market volatility is going down a lot, and you keep getting bond market inflows, because if you're a bond investor, you see inflation falling in the future, you allocate more to bonds. A lot of that's systematic based on baby boomers and stuff like that. So I think this is overall good for asset prices and market and stocks at the end of the day. But to your guys' point, like inflation on the ground for labor might be entirely different. The funniest part about inflation is, like, if you measure a basket of certain things, it's different for every person. But the market-based inflation metrics that I'm looking at, and what all financial people look at, and market-based people are saying, we're in a disinflationary environment, which is what, Warren Pies said on Felix's podcast this week too. It's like he could even see oil going to $50 a barrel. In that case, man, the Fed could be on a major easing cycle. And so from a market-based perspective, yeah, I think this is bullish. I think inflation is slowing on a market-based perspective. If you're in labor, you could probably have entirely different data. So this is a very polarized environment on inflation. But overall, I think if you have a slowing rate of inflation, disinflationary environment, asset prices are going to slowly rise as the whole engine of bond market inflows, stock buybacks keeps just chugging along in the background.
Hey everyone, this episode is brought to you by Avalanche. Avalanche is a leading network of blockchain, which is giving access to some of the world's largest financial institutions to experiment and build on crypto rails. I'm a big fan of Avalanche. I've talked about it on this program before. The Subnet architecture leverages some of the best parts of IBC over in Cosmos, the interoperability protocol, and the rollups on Ethereum, with the result that if you're a financial institution, you can build on something that's highly interoperable, but also customizable and scalable. And it's not just me. Many of the largest institutions in the world are taking notice. And a couple examples of folks who are building on Evergreen subnets include Onyx by JP Morgan's. They leveraged an Evergreen subnet to explore how tokenization can revolutionize the asset and wealth management industry. Citi and the DTCC digital assets are testing private market tokenization on the Avalanche Spruce testnet with Wellington and Wisdom Tree. So again, some of the largest financial institutions in the entire world are building on Avalanche. Avalanche Evergreen provides a suite of institutional blockchain deployments, customizations, and tooling designed to address company-specific and industry-wide requirements for financial services. So join the institutional investors that are choosing Avalanche today. Go to avax.network/evergreen. Again, that's avax.network/evergreen and join the revolution. Avalanche, thanks very much for making this episode possible.
What's getting confusing now too is we've had a pretty US centric view on the show today so far, but globally, central banks are starting to cut. We had Bank of Canada cut this week. We had the European Central Bank cut this week. We had the Danish central bank cut this week. So outside of the US, like, the economy has been slowing. The guidance has been towards cuts more so. It was only the first cut, so that's just the beginning of the cycle. But it's definitely interesting when you look at the rest of the world right now and where they're at compared to the US right now. And that's, to me, going to create a really interesting framework for this coming June FOMC meeting, is that if this trend continues, which, just one cut like this isn't going to create a huge change in like currency rate differentials, which is one of the key drivers of currency pairs. But if this trend continues where the Fed starts to signal that they're not going to cut until 2025, at the same time that every other central bank, G7 central bank, is cutting, that's going to create some huge swings and volatility in the currency market, where we just see U.S. strength and the DXY continuing higher while all these other currencies get debased. And it's a really interesting narrative. And I think when we talk about this secular vol control and basically controlling of volatility in the market, for the past 30, 40 years, most of these global central banks have been coordinated in their monetary policy so that you don't see this volatility in the currency. Because if every major central bank is cutting at the same time and they're all getting debased at the same rate, you don't see that show up in currency pairs because it's a relative valuation, right? But if you start to see the US central bank hold flat and these other countries start to cut, suddenly that creates a lot more volatility in those markets. And then that gets, like, everybody gets affected by a currency pair and a currency rate. So that creates this huge dispersion, which is, I think, going to be my word of the week so far. But what are you guys seeing? Like, do you think this trend continues, or is it just a one-off? I know the ECB was signaling that this was, they did this weird thing where they cut, but they also increased their inflation forecast for the next year. What do you guys think?
I think the emerging market currencies and ECB, Bank of Canada, et cetera, they're just leading in terms of the easing. And I think the Fed will be close behind. I think you're going to get a weak dollar policy into next year, especially if you get Trump and Lighthizer in there. They're already signaling it. And I think that's coming down the pipe because we need nominal growth to delever the economy. And Trump is aware of that. He's leading in the polls. I think that's coming down the pipe pretty soon. You might get a little currency volatility, as they ease and the dollar pop in here today. But I don't know, it kind of feels like they're looking through it. The election's getting discounted already, in some senses. So we'll see how long this dollar strength lasts.
I'm glad you brought that up, Felix, that point about the ECB cutting but raising their inflation. To me, that was the most important, maybe the most important thing of the week. And, you can't blanket it to all central banks, but you basically can, because everybody's said that quiet part out loud, which is the inflation target's a joke. It never meant anything anyways. And we're cutting interest rate despite thinking inflation goes up. I mean, that's completely 180 opposite of everything we've heard from central banks for the last 2-3 years. So I think that tells you all you need to know.
Yeah, this is the next stage of the liquidity cycle, I think.
I've got a question for you guys. We talked about this a little bit on our group chat this week, but it was an excellent Louis Vincent Gov interview with Dimitri Kofinas on Hidden Forces. And he made this really interesting point about what the US is trying to do in terms of reindustrialization, which is, hey, we've had a really strong dollar. Lots of other countries around the world, especially in emerging markets, have been artificially depressing their currencies to compete in terms of exports. We are waking up and recognizing that that's an issue, especially because of the war in Ukraine. Like, we can't even supply as fast as Russia. And so we need to move some of that industrial base back over here. And you saw that with the CHIPS Act and for other key technologies. The challenge that he points out with that is that it's extremely difficult to do that with a strong dollar. And so I think there's this really difficult choice that the US has to make in terms of the strength of the currency, in terms of reindustrialization. And then Trump I agree. I think he'd be a very populist, kind of get the dollar down, exports up, manufacturing sector, rah, rah. How do you view that within the context of, let's say, global central banks started to cut pretty aggressively, or move into their easing cycle faster than the US? Because I think what that should do is suck capital into US bonds and the dollar. And that runs counter to the interests of policymakers at the current time. So it's kind of an interesting, usually you think about the Fed as being in the driver's seat for global central banks, but that might actually not be. It's kind of like you've got two opposing forces here. I'm curious to see how you guys see that playing out.
I think the politics end up ruling, and I agree. You could have little spikes in the dollar, but at the end of the day, you can manage that down with political jawboning. And at the end of the day, we do need to reindustrialize. That is the big gorilla in the room. We need to reindustrialize it. And, Louis made the best point at the end of that podcast. He said, the compromise that US elites made was they wanted their house in the Hamptons to be a $25 million house instead of a $5 million house. And the compromise you make to have it $25 million is you have to annihilate all of the US industry. And that's largely synopsizes this giant globalization trade and elites and the political backdrop of everything. Is they sold out America in a lot of senses. And to reindustrialize, you have to have a weak dollar at the end of the day. And I think Trump knows that. I'm pretty sure Biden's probably going to piggyback on top of that heading into the election. So we'll see if the politics rules versus the what the inflation is saying and the dollar saying.
The other market barometer of this is European and US bond yields are up since the ECB cut rates and raised their inflation target. So what's that tell you? Well, it tells you that the market's saying, okay, we'll take you at your word. You're going to cut interest rate when inflation's still a problem, and the term premium is going to go up and yields are going to go higher because we have to price in more premium of future inflation in your bonds. And I think the exorbitant privilege of the US with the world reserve currency and the liquidity facilities from COVID, namely the RRP, is what's allowed us to maintain this dollar strength, because we've been able to tap these artificial liquidity facilities without having to ease, whereas the other countries haven't. And so once that goes, then the dollar goes, in my opinion.
It's a super fine dance that needs to happen right now. And tying back to what we were talking about with the ECB and cutting while being hawkish on inflation rates, that's really the financial repression playbook. And it's this dance where they need to lower debt to GDP ratios. And by doing that, they're keeping rates artificially low at the same time that inflation goes high. And what occurs is that you have a higher above trend nominal GDP growth rate at the same time that you're issuing debt at artificially low prices. And that creates this ratio of debt to GDP to come down. But you need to be doing that very carefully because you don't want to spook the bond market. And I think that's a really interesting point that you brought up, Quinn, that European yields have been going up because that's the dance. They want to do this without those yields getting crazy, or else you're going to get something like another European debt crisis where those things blow out. And that's what always weirded me out about how they set up the European Union, is that they decided to have a common currency but different bond markets, because you have different like credit grades for those different bond markets, but are anchored through monetary policy through a common currency. So you have much more risky Greek bonds versus like a German Bund that is doing fine, and you're always going to have to play as a ECB like central banker. You're always going to have to play to the weakest bond market within your union, and I think that's one day it's going to bite. It was biting quite a bit a couple of years ago, where we started to see like Bunds, I think, compared to Italian bonds, blow out pretty aggressively. But there's going to be a lot more of that to come, I think, because they want to basically lower that ratio without spooking the bond market. But that's a difficult game to play. It's very difficult.
On the plus side, the demographics actually favor in the systematic flows. It to me, they might get a Goldilocks scenario, because all of these life insurance companies and pension funds, they're systematic. They have to invest in bonds. But in my brain, I go back to the Bill Gross, is like, why they call it like certificates of confiscation. And you're basically playing not to lose if you're, a boomer. And so I think that's why you still have the bid in bonds. But like, if you're in our generation, you're probably thinking like, why would I own a bond if inflation for me is going up? Your only resort is literally like stocks and Bitcoin. That psychosis was the same as you saw in the Weimar Republic, where a generation of people just didn't invest in bonds because you lost your value. It was the government co-opted the bond market, and you have to be very careful about that. But for now, the 2s to 10s curve's flat, bond inflows are there, things are pretty Goldilocks.
It's funny, I didn't write this piece yet, but I have this long spreadsheet or like Notion doc of notes that all are the same idea but playing out in different ways. So US dominance versus rest of world dominance is an example. Like crypto majors, Bitcoin dominance versus altcoin dominance is the other thing. And your latest example, Felix, within the ECB or within the EU, the difference between smaller economies and like Germany. And all this has to do with the macro backdrop. The European example you point out, it's actually horrible for German, the German influence on the ECB, and they have the biggest say and they're the biggest economy, and everybody, it benefits them outsized when they should have a much stronger currency, much higher interest rates, and the weaker economies should have a much weaker currency and lower interest rates to spur. And when the weak economies go into recession, they don't get that benefit because they're beholden to the ECB and EU. And I totally agree that those things will come back up again because, and actually it's better for these countries when you get this inflationary pressure because it evens the playing field.
I have one more point, by the way, on the jobs print, like something I've been thinking about, which is, I don't know if you guys have actually read like where jobs are being created there as well. I know, Quinn, you got into that a little bit, but one of the really consistent drivers has been the healthcare sector in general. The thing that, just as an employer, right, at Blockworks, like I see healthcare costs go up 10% every year, like clockwork. Like you don't see that as a raise, but Blockwork, like I see it as like everyone's getting a 10% per raise every single year. And that's staying pat. And there's this giant principal agent problem that exists in some sectors of the economy where the people that are paying are not the same. There's an agent in between the people that are actually paying versus bearing the cost. So for something like healthcare, consumers don't have to pay that. Companies have to pay that, and creates this weird principal agent risk. Additionally, the other sector, which is also consistently adding jobs, is private education, which is another one of these sectors where Mark Andreessen has done a really great job of saying that the US acting as a big price insensitive buyer of education drives costs up. So I forgot to say that in the note. We don't need to go all the way back there, but a lot of the sectors that are and then the other biggest contributor is government jobs. If you look at this jobs report where jobs are being created, it's literally government jobs, healthcare, and private education. So a lot of the sectors that are creating jobs are actually these sectors which are either directly or very indirectly related by government spending, which I also thought was an interesting thing to point out.
That's what I was just going to say is before you said the government jobs, I was like, ooh, what do those two things have in common? Healthcare and private education. It's the ones that are controlled by the government, and they're the exact people when Yellen or Powell gets on and says, we're trying to help the average worker and we're easing policy and taking wealth from your pockets and putting in the rich. It's the biggest fallacy thing in the world.
Man, Russell Napier has absolutely nailed this call. I remember a couple of years ago, he started to talk about this, about financial repression, but also go long anything close to government spending flows. And he was like, healthcare, education, government expenditures, just like get there and get long, because that's where the jobs are going to be created. That's where the money is flowing. And, he's just the type of guy that, like, when I see him being interviewed, I'm just like sprinting to my laptop to listen. Because
how dumb are we for not buying 2025 NVIDIA calls when the government announced their CHIPS Act? Like that was free money.
You know what is also a great rule of thumb is the Peter Thiel things mean their opposites all the time. So like when you call political correctness, it's really like political incorrectness. Or if it's an Inflation and Reduction Act, it really is the Inflation Act. And so it's like such a human nature thing is when you're part of an institution, you have to name something and it ends up doing the exact opposite of what it does. It's just like, I wonder if our generation flips that, where you're like, come on, like, let's be honest. This is the Inflation Act and, it's not the Inflation Reduction Act.
It's like saying no offense before I dig you, No offense, but yeah, your hair. Eh.
I'm not racist, but
yeah. Wait, also speaking of out of the money or call options, do you guys want to talk a little bit about the return of Roaring Kitty that happened this week?
Yes, I have a rant, but I want you to hear you first. Because
I saw that. So, all right. So Roaring Kitty, obviously, Keith Gill made headlines back in 2021 when he went into these deep out of the money call options on GameStop. And that all led to, this kind of mania. He was sort of the poster boy of meme stocks that were happening during that time period. He actually got hauled up in front of Congress, and people like Elizabeth Warren, just shows you which side of history she's going to go down on, chastised him as a market manipulator, all of this stuff. And then a movie, Dumb Money, got made about him. And he started posting he started posting again last month. And then he one of the reasons that he got so famous is that he would post live updates to his positions. And I just didn't make the connection. I'm assuming most other people just stopped thinking about this guy years ago. But the original out of the money options that he bought are dated for June of this year. And he has printed, and it turns out he has reloaded in an extremely heavy way on these options. And yeah, he just posted a position size of $586 million. And GameStop has been going nuts. And I didn't listen in on it, but this morning there was a live stream that he did, and I saw that 45,000 people were in the waiting room just going nuts over this stock. I don't even know if it's more, to me, it's a human interest story at this point. It is just amazing.
No, it's so much deeper than that. This is a generational story.
The calls he purchased in 21 those were June 24 calls.
I think so. Yeah, that's what it looks like.
No, I thought he bought new calls.
Yeah,
like
I thought
in the
it's
last
a new
month.
position.
Oh, okay. Never mind then. I'm wrong.
I was gonna say that would have been just
right before Tyler rips into this. I just want to say two things. One, somebody's going to get hurt in this, and I know a lot of people got hurt last time too. But two things I'm looking at. One, GameStop has pre-authorized a ton of equity issuance. They already pre-authorized another amount to get issued today, and they've just been doing that relentlessly. And I made a pretty bad analogy to it being a callable bond that Quinn already called me out on, so I'm not even going to bring that up. But basically what I'm trying to say is that the stock has a capped upside, is that because as the price goes higher, they can just keep issuing equity. And last time they weren't pre-authorized to do that, but this time they are just ready to just keep issuing equity like crazy. It's their fiduciary duty to do so because of just how overvalued the equity is versus like the debt or any other form of capital issuance. So that's going to keep happening. And that also, the second part is that short interest is a fraction of what it was last time around. So there's not that narrative either. And those two things are very different from the last cycle. And just the psychological component of, I just don't like, I traded the GameStop thing last time. I was decently early to it and it was great, but I'm not touching it with a 10-foot pole this time. I just don't like repeating theses because markets are somewhat efficient and that gets accelerated. Those are my 3 points. Go for it, Tyler.
Hello, listeners of On the Margin. I've got good news for those of you who are in the crypto scene. Blockworks is bringing back permissionless. We're going to be doing permissionless 3, and this year we are heading west. So we're moving that out to Salt Lake City. That's going to be October 9th through 11th this year. We've got a phenomenal lineup of speakers for you. So we've got Balaji headlining. We've got Shriram, Munib, Matt Hogan of Bitwise, Jan Van Eck. This one's going to be a blast, guys. And I saw many of you out in London for DAS this year, and I hope to see you out in Salt Lake for permissionless. And because y'all are such faithful listeners, if you use code MARGIN10, you're gonna get 10% off your tickets. Appreciate you all. Hope to see you out there.
Okay. This is going down a philosophical rabbit hole. First off, I'll say this. All right, GameStop is down 20% right now. And I'm looking out, this is just derivatives, some basic math of what this looks like. If you go out to July 19 and you sell the 16 put, so the 16 put is 55% out of the money. Also, this is not investment advice. This is just to set like your yield expectations, right? So if you sell that 16 put a month out, you can sell that at $1, which is in a month, you can get a 3% yield. So how you do that math is you sell the put for $1, that's 55% out of money. And you divide it by the spot price, which is like, say, $35 right now. So it's about a 3% yield. You can make 3% in 1 month by selling a 55% out of the money put. That volatility is about 215, 217 right now. So you can basically buy GameStop stock down 55%. And if it expires worthless, you make 3%, which is 36% annualized. Does that make sense? This is probably a little bit, derivative heavy, but the point is, if you want to play it conservatively, sell puts. You're getting an outrageous deal to sell insurance right now. You're selling insurance when everyone's buying insurance. That's when implied volatility is super high. You sell insurance because like the stock going down to 16, it probably won't happen because of, this is my macro point, centralization. It's going to be really hard in a month for this stock to fall 55%. And this is not investment advice. This is just looking, we're not long this or anything. The top holders, the float is tied up in this thing, which is why he's buying out of the money calls. So RC Ventures owns 10%, Vanguard, BlackRock, State Street. This is the centralization problem in a microcosm. And I wrote about this, a couple of years ago. But the passive and quant market has perverted, public markets because they buy when they get inflows. They don't sell if the stock goes up at any price. So it constricts the float dynamics of the stock, which creates opportunities to have these things called gamma squeezes, which is where you buy out of the money calls and you create, like, this will happen more and more as the government stifles volatility in markets and passive keeps gaining share. And this is centralization. It's systematic communism. You don't buy stocks. You do not buy stocks for just because of price action. This is where I saw Cliff Asness, which is AQR, one of the biggest quant funds, call Keith Gill a grifter. That interaction is really fascinating to me, especially now, because you have a quant guy who's basically like input all the data, all the left brain stuff that like has been commoditized over the past 30 years versus this guy who figured out like what actually happens when you constrict the floats. The math gets convexity, right? Buying out of the money calls. This is a centralization problem, which, this is the microcosm of why you should own Bitcoin, right? Because markets are getting too centralized. You've cut prices too low. Spreads have come down. Passive has gained too many assets. The number of active ETFs in the US is now 40% of the total. So passive keeps gaining share, right? And, they don't sell things when they're overvalued. They know that's not part of the inputs, right? And so this market structure stuff is going to happen more and more as the floats get constricted and the systematic inflows happen from 401ks. This is a market structure issue. And then if you go on top of it, the systematic vol selling. So you have constricted floats, then you have this volatility selling, which like last week we talked about this. And I was like, the VIX, buying VIX calls and buying S&P puts does not work because you have derivative income funds now extracting that, selling volatility in the market for yield. And so you have these, this is really just Piper Sandler's chart of, 70 billion in assets in derivative income funds. It's way bigger than that. It's like 10 times the size of that. But, for shits and giggles, we'll put that. And then if you go to the next slide, which is slide 20, these are the systematic, quant funds, which is when volatility falls, they have to reallocate into their equities and things grind higher and higher. This is Cliff Asness quant, 101. Your input is the VIX. Let's reallocate, And so my end point is that you've centralized asset management so much that this GME thing just scratches the surface on how messed up the market structure is. And eventually our generation is going to come in. They're going to be like, yeah, you can't have you have to start buying stocks because of fundamental reasons. And because like the CEO has a good, he keeps the social contract intact, not because price inputs, from the last month tell me quant funds say blah, blah, blah. It's left brain is run amok. And now there's, absolute fund returns. That's why guys like Cuppy outperform and guys like, Keith Gill, that will start becoming more of an asset, a strategy because of the centralization of asset markets. I think that was a long enough rant. Did that make sense?
Yeah, I think the thing that I find interesting is everybody talks, all you hear on Twitter is the rise of passive, decline in active, but no one talks about the obvious knock-on effect, which is as the percentage of passive goes up, active should outperform. Like if you get to a market, let's say that's 99.9% passively allocated with no fundamental value-based investing, if you're an active investor, you should be killing the market. And so I find that that point isn't talked about is pretty
not
interesting.
Necessarily though, because you look at it's that chart of like the top 7 where the market cap money goes into the market cap weighted stuff, and then you have benchmark risk, right?
Right.
So Now these mutual funds that have benchmark risk are forced to benchmark, and it creates like this stupid incentive that's just so centralized. And
that's assuming it never reverts to any
well,
historical appropriate level.
what usually gets it to revert is if you actually let the credit markets be free. And that's why the vol control
They're the opposite right now. Yeah.
Right. You keep the volatility, and then it creates these perverse things start happening in equity markets. And it's just going to keep happening, right?
I mean, Cliff Asness in like a billionaire, like going against this like retail guy is the same thing as the people. It's because he doesn't benefit from it. It's the same people as who got blown up by GME last time. Of course they hated this because they've benefited from the system for the last 20 years and that they become billionaires. And when one thing goes against them, it's like,
poor men want to be rich, rich men want to be king. The king ain't satisfied till he rules everything. And like we're at that point. Like Bruce Springsteen said that, and like it's so spot on. Like these guys, like what do you expect? The social contract breaking, and like you keep wanting to centralize power because your stuff worked. Like it worked. It worked great, but now you're mad because like this guy's making a couple $100 million because now he's exploiting your stuff. Like that, this is why it's a bigger issue than anyone says. And I think this is a pretty original take because I actually know market structure. The other interesting thing I wanted to mention is 50% of the trading volume is HFT now, right? So take that out, right? That means that normal buyers and sellers that buy things are only, under 50%. So if you have $5 billion of buyback flow a day, you are really way more of the individual. This is part of the volatility stultifying. Like when you have these massive buybacks, it's a debt for equity transfer. And you are, say you're 5% of the trading volume as Apple or Nvidia or Meta who have these buybacks going. You could be way more of that trading volume than you think because the HFTs make it seem like it's way more liquid than it is. And so when you have that bid in there, that's why the VIX keeps going lower, because this is the main bid in the market. And it has been since 2010 and you have these brief spurts of credit problems. You have the Israel thing cause oil breaks it all, right? Like that's why we watch oil. That's why we watch the yen, the carry trade, and these things are right now. They're just the market's at all-time highs, and it's just going to keep going into the summer here unless we get a geopolitical event.
I think this is where a lot of traditional macro people get messed up is they look at, say, equities and they compare it to their earnings multiples. And it's like, oh, this is ridiculously overvalued. Why isn't this not mean reverting lower? And, it's been happening for years. There's a lot of people that nailed 2008, but then, went bankrupt from 2010 to 2020 because they didn't see the shift. They didn't notice that, okay, now we're going. I've been rereading, or actually just reading for the first time, this book called Laws of Finance, which really outlines the history going from basically where this all started in 2010 when quantitative easing was started for the first time to basically what's happened in the last few years. And it's really destroyed a lot of those fundamentals, which leads to a lot of people making money and for markets to be driven by more of these market structure components that you've been talking about, Tyler. I think that's a nice transition point to talking a bit about the crypto ETF flows recently. In this world where we're not seeing any sort of solid signal in traditional markets, I think a lot of us believe that this is one of the last true free markets in the world. And we've been seeing a pretty substantial increase in ETF flows into the Bitcoin ETFs this past week. At the same time that we're starting to see more talk about what's going to be happening with the ETH ETFs. And I'd be curious to ask you guys, like, what do you think has been driving these inflows over the last week and a half? Because it's just been like out of nowhere, just going higher. I have my theories, but I'd love to hear your guys' first.
I think the macro people are noticing, and if you look at the composition of the flows, right, it happened broadly across every ETF, and so that says it's some broad purchasing, not like. I mean, I do think we're getting to the time where the RIA and other wealth channel flows will start to turn on in a bigger way, but this is a lot of participation, and the only thing you can really point that to is a macro expectation of liquidity, in my opinion.
Here's one thing about Bitcoin that I think people will wake up and remember is just how reflexive buying tends to be around something like Bitcoin. This is where the lack of ability to do a DCF is both a gift and a curse. It cuts both ways, and I think it's about to start cutting in the good way, because when Bitcoin goes up, and we've all just been waiting for this convincing break of the previous all-time high, and I think once that happens, that's when like everything picks up, including inflows. I'll be curious. We were debating a little bit this week. I'd be really curious to see what the inflows look like on the ETH ETF. I think I'm starting to be in the camp that it's at risk of underwhelming, being slightly underwhelming, especially relative to crypto native expectations. There's a lot of people on my timeline I see saying it's going to blow through everyone's expectations on the ETH side of things, and I'm less convinced about that right now. Quinn, you shared a great research piece in our chat this week, estimating somewhere between 10 to 20% of the AUM of the Bitcoin ETFs, and I'd probably be in that camp, maybe towards the lower end of that. But
yeah, to me, it just depends on the market regime. If the ETF launches and we're in a situation where tech and AI and everything's booming, that's when people are going to say, "Oh, cool, Bitcoin, but what else is there?" And then they go into ETH. If we're in this choppy liquidity, stop-start type of market structure where people are more worried about a growth slowdown and central bank easing, then they're going to want the digital gold. So I tend to agree and think that again, I'm super biased, but I always kind of pin stuff on the macro.
Do you think that that's the perception of ETH, is that ETH equals tech? There was a period of time where I believed that other people believed that, but that's why I've always been such a non-fan of this ultrasound money thesis for ETH. It like really clouds it. And if you talk to, this is where I can't tell if I'm like too in crypto and like I got to get out of my bubble here. But if you listen to people at the Ethereum Foundation talk about Ethereum, they talk about it with it. They want it to be like in this money conversation, and to me that just muddles the entire thing. It's not like an easy. So do you still think that people broadly think of it as like tech and smaller cap, so it might be more upside? That's how I used to think about it, but I'm not sure that that's the general perception anymore.
Yeah, I think like ETH is missing its elevator pitch, one sentence thing. And there's been phases of it where I've agreed with it, like you, Mike. Like I liked when it was pitched as, the world computer or something like that. But I was never a fan of ultrasound money as an idea. But I do think there's a place somewhere for somebody to be questioning Bitcoin as the king for that, because it's almost perfect as money, but I don't think it is perfect as money. I still think there's things to figure out in terms of, is that 21 million cap true and hard or not? And a lot of that comes down to where do you believe miner revenue comes from and that sort of idea. So I do think there's still things to figure out there. So there's a place for somebody out there or a protocol to be thinking and questioning and testing those things, but I don't know if it should be Ethereum or not. I think there's a lot of opportunity for them to live in a different space for that, and for whatever reason the foundation doesn't, it wants to be that person that is questioning money in terms of like digital money and competing with Bitcoin.
Yeah, I think crypto natives are wrapped around the axle on that. Like at the end of the day, if we're going to get billions of dollars of inflows in the product, like people are going to know what it is and do their own research. And like, so the crypto native narratives always usually miss the plot. So I don't worry too much about that. I just think comes down to what kind of exposure people want.
Just looking at the chart though, it made new highs. The discount on ETHE collapsed and has actually not sold off at all in anything macro in the past, week or two. That's pretty bullish. I don't know. I think the setup is, you have long-term cup and handle here. This is just, complete technical stuff. But the fact that it did not sell off at all, when big tech sold off or any of that stuff is a pretty good sign.
I have less of you know what else was, I thought, an interesting story this week was, I don't know if you guys saw that Robinhood acquired Bitstamp. So Bitstamp is the oldest, longest standing crypto exchange. They've largely moved out of the US and been pretty active in Europe. And honestly, the purchase price was really low. At least from what I saw, it was like $200 million all in cash. Really good deal for Robinhood. I think it's a really compelling value proposition for Robinhood here, and shows that they're jumping into crypto with both feet. And I think it sets up a pretty interesting. First of all, I think it's very bullish for Robinhood. So I think Quinn, something you've been right on there. But I think it sets up a pretty interesting competitive dynamic between Robinhood going further into crypto, and I think Coinbase is actually expanding out from crypto into, they're trying to get into regulated futures and stuff like that. And so I think that sets up a super interesting dynamic. But it's also recognition of this idea that I think some of the challenges that you were talking about from a market structure perspective, Tyler, is I think crypto's long-term a beneficiary of that. Not in like the next year, people are going to figure that out, but it's a much freer market and devoid of some of these problems. So I thought that was an interesting story this week.
Check out the chart of Robinhood. I put it on slide 12. This is not long it or anything, but just from a 2-year like base, this is it looks incredible. Look at that thing. Like this is exactly where it broke down at 20, broke through there on good volume. I mean, the retail investor could be back here, and that's with GME, GameStop happening at the same time this is happening. It's kind of fascinating where, it could be I think it's the next stage of the liquidity cycle, like Mike Howell talks about, where the retail investor comes back again.
Yeah. This chart looks like Coinbase from 6 months ago.
Yeah. Yeah.
There are a lot of cup and handle charts. I will say, I know you pointed to ETH, but like every major asset or like crypto, like Bitcoin looks like that. Solana looks like that. You know what else actually recently broke past its all-time high is BNB, which is hilarious to me because CZ is literally in jail. And,
the biggest holder can't sell.
I know. Yeah, I saw that.
Bullish.
I love how crypto Twitter always misses the mark on like what's actually really nailing it. Like nobody talks about BNB and they just see it as a scam coin, but it's like just sending.
Yeah, and the other thing is, I know we also talked about it, and there were maybe some mixed feelings about this podcast to these individuals, but it was funny to me. I watched the All In podcast from last week, and you've got these guys who don't really pay attention to the ecosystem dusting off the old halving charts and doing their quantitative analyses about this is how much Bitcoin tends to go up after a halving. And the framework guys actually get, because I've been curious, not even from like an investor standpoint, but just from my Blockworks hat standpoint of when there's like no new entrants coming into the space now. And the framework guys actually reminded me that it would be atypical. Like this is not usually the time when there's like the big inflows of like new people coming in. That comes around the sort of euphoria phase, which just, yeah.
What's the proprietary Blockworks data saying? I mean, this is where you gotta this is where we need the real
research.
Yeah.
Yeah. The Blockworks data is saying that people are not coming into the space. Like that, this audience is doing great, it's growing, but it's not like it's not like if you have to ask, then it's not happening, because the last time it was like nuts, like everything was way up and to the right. And I talked to like the Bankless guys also, and a bunch of the other like podcasters and media companies in the space. It's all the same thing. Like everything's pretty static.
This is a good incremental data point too. One of my buddies opened his Coinbase at work the other day, and one of his smart coworkers walks by and he says, "Oh, are you on like Coinbase? Is that like crypto stuff still going on?" And he was like, "Oh my God, this is so bullish. Like no one's here yet." And it's at all-time highs, and the sentiment's kind of, it wouldn't signify, a blow off top. Like that's what I'm looking for when, Mike starts wearing Gucci vests and like, gold chains and stuff.
Well, you're going to be waiting a long time for that.
He's gonna have like more penguins and stuff. You gotta look.
Yeah, exactly. You gotta look for the number of pudgies. Yeah, exactly. Oh yeah, let's do meme of the week here. So
this was an absolute just obvious banger. But this meme from the CEO of NVIDIA signing a fan's chest is just beautiful. It's really funny. Like whenever these sort of things come out during markets, people just love to pile in and say, "Oh, this is a top signal," and like, "Oh my God, sell everything." And like I don't know, that just feels like the most forced thing ever. Like I always remember this quote that somebody, I forget who said it, but they're just like signs of adoption and signs of froth look indistinguishable at market highs. And this is a great meme, but like,
what kind of adoption is this, Felix?
That's Suzu who said that.
I wanted to
and I believe he was talking about Axie Infinity. So So
My point being, more people have been steamrolled calling top signals on memes than making money, probably.
I'm bearish on this, just given the sentiment is frothy a little bit. However, I'll go back to my point. I made this like a month or two ago. Number one, the market structure is so screwed that like, you know, if NVIDIA doubled here, it wouldn't like surprise me, because like the float keeps shrinking because it's a huge weight, yada, yada, yada. So that wouldn't surprise me. But and everything you want, I don't know anybody individually who's like living in a $20 million house and, you know, has killed it on NVIDIA. Like, we talk about it a lot, but how many people do you know are like swimming in it? It feels like the most diversified, balanced stock. Like GameStop, I'd see more people I know have played GameStop and made a lot of money than NVIDIA. So that's where I'm like, I don't know if it's a blow off top just yet.
And the earnings have been following it.
It's like the institution's meme stock.
I think we get some fireworks before it's all said and done. But like, yeah, this is definitely one of those indicators where you're like, antennas are up.
Well, I want to give a shout out to Felix this week for an incredible interview with Warren Pies. And there was a great clip that got posted that you clip, Felix, where he's talking about this kind of rampant doomerism that you especially hear on like macro circles. And he made the point that like even guys like Stan Druckenmiller, who will go out and talk about the fiscal crisis and how concerned he is about oh, Quinn hated that, about how concerned he is about the US and all that stuff. You got to look at what he's actually buying, which is NVIDIA, which I thought was such a good point. And it also speaks to the idea that like it is kind of the meme stock for boomers. But I'm certain that I'm wrong on this in some way that I'm just not understanding. But like, just on the NVIDIA point, the one thing that does make me like a little bit concerned about it is this is a pretty classic capex build out here, and you look at the amount of money that OpenAI and Meta and all of these platforms have said that they're willing to spend on GPUs, which is a ton. Like Mark Zuckerberg said, I'll spend $100 billion on GPUs. And they can do that for a little while. But that letter that Brad Gerstner from Altimeter sent about the work that they were doing on Reality Labs and their metaverse division proves that they can't do that unsustainably forever into the future. And I feel like, I guess the bear case for NVIDIA would be there's some kind of clock, right, for when these enormous gains in productivity for AI need to materialize. Otherwise, it just has to impact the capex spending at some point. These are huge numbers that are getting thrown around here. And I would also point to the history being like, when you have these incredible capex build outs, they're almost always productive in the long run, but the vanguard tends to get burned on these things because it's just really difficult to plan for demand around this. And I don't know.
Especially with how constrained and tied it is to energy and just energy capacity. Like, it's really funny to see now a lot of people that were talking like, I don't know, about the green transition and solar panels and that. Now it's like, oh my God, we need nuclear plants because look at all this energy that we need for AI like data centers. And that's going to be really tied to the hip, I think, of the answer to that question, Mike.
Where are the articles? You know, over the years, we've had hundreds of articles and headlines about how Bitcoin is boiling the ocean and ruining the planet. And look at all this energy. Where are the headlines about all this AI-driven energy? I wonder, you know, fewer of those I've noticed.
Yeah, no coincidence there.
You know what else is interesting is, I don't know if you've heard this narrative, but like AI is now going to pay Bitcoin miners for their like compute capacity. And so because they need, you know, a lot more like compute capacity apparently, which is kind of interesting. This battle of like, if you say AI is, you know, communist, then, you know, Bitcoin is capitalist, where who's going to win the battle of this compute? Like that's a fascinating like idea. Because I don't know, AI kind of scares me, to be honest, especially when it's run by the big tech companies. Like, I don't know.
There's so many, mostly vaporware and scams, but there are so many attempts to do this like AI crypto crossover where like the simplest applications are just exactly what it's like Airbnb for compute type thing, where these different, they're H100s on the network and they're renting out excess compute that they have to whatever applications. it's such early days. It's way far off for that to actually materialize any benefit. But there is this time. Actually, there was Nick Carter wrote a great piece, a long tweet this week, and there is a deal in between Core Scientific and CoreWeave, which is sort of a data center and one of the largest miners that's based out of the US, which I think is getting at what you're describing, Tyler. Maybe we could talk a little bit. I'm like firmly in the mid curve on AI. I'm not really sure I have any, particularly interesting opinions on that. I think we're in a little bit of a hype cycle right now that's going to die off, but eventually it's like the real deal and going to impact things. I would be interested to see when the deflationary impulse from AI actually shows up in the numbers and productivity.
I definitely take Druckenmiller's point of view, which is that we've severely overhyped it on the short term and severely underhyped it on the long term. And I think that's just classic tech adoption.
Wouldn't it be funny though if in the long run, if you had to steelman the case for what policymakers are trying to do right now with all this easy money and all this stuff, they're looking for some crazy new technology, right? That's gonna get their way out of this. What if that is AI? Like, what if on the eve of deglobalization and demographics rolling over and all these super inflationary drivers, you just get the mother of all deflationary technologies, which is AI. Wouldn't that be?
I feel like a lot of us are hoping for that quietly, but don't want to say it out loud. I mean, the one person who is saying it out loud is Raoul Pal. He's like, that's his core view. It's just like, this is our saving grace for productivity and deflation, but it would be nice.
What's kind of crazy, and this is Mark Hart math, but all right. So say you have a productivity boom, and productivity adds another 3%, but at the same time, because you have to do universal basic income, you have 3% inflation, and so if you have a basket of goods that's $100, and you have 3% productivity, at the end of the year, that basket of goods should be $97. But then you have 3% inflation, so that basket of goods should be $103. So the delta between those two is 6%. That is the tax you pay to the issuer of the sovereign currency. So if you have productivity going more productivity and inflation going up, that gap, as it gets wider, you should be in a store of value because you're getting taxed by the sovereign, that delta between those two. Does that make sense? So
yeah.
So basically, like this, it's a scream for Bitcoin, right? If you have, productivity boom and inflation backed by fiscal spending, that's like the sweet spot for why to own Bitcoin, because it's a store of value, right? And it's deflationary. Like, so that math is what really makes me bullish long term on this stuff.
Yeah. I can't wait for Dogecoin to become a long-term store of value, and everyone, it's going to shock everyone, be very offensive, but yeah.
That was a great one. Great to chat again.
Yeah, guys, that was a lot of fun.
See you next week.
See you next week.